Imagine a hard month flipping burgers at McDonald's. You get an email saying you've been paid $2,000, but when you check your bank account, only $1,456 arrived. Federal tax, state tax, Medicare. A significant chunk of your labor vanishes into the hands of invisible forces before you even touch it. Take Social Security. You see it on your pay stub, but it functions as the government forcing you to save for your own retirement. They pull that money out of your hands now, holding it so they can pay it back decades later. This system relies on a deeper layer of participation. The currency we sacrifice so much time to earn and so desperately try to protect holds no actual physical value. A $100 bill is composed of paper and ink. It carries no weight on its own. It only buys groceries because we've collectively agreed to treat it as a store of value. Traditional fiat currency functions entirely on this shared societal agreement. This agreement applies regardless of the medium. A purely digital token like Bitcoin holds purchasing power for the exact same reason physical cash does, because millions of people woke up today and agreed it is worth something. Money is a social construct built on specific artificial rules. Navigating your life without understanding how these mechanics work ensures you remain a passive participant in a system designed by someone else. When you walk into a bank and hand the cashier your money, you might picture it sitting in a vault, being guarded until you need it. In reality, that money is already gone. This diagram shows the process of fractional reserve banking. When you deposit $1,000, the bank only keeps a tiny percentage on hand. The vast majority of your money instantly flows outward to fund someone else's jet ski or mortgage. In this system, you act as the supply of money, and the borrower acts as the demand. The bank functions as a middleman, lending your capital out at a high rate and returning a tiny fraction of that profit to you as interest. To decide who gets access to this pooled money, lenders rely on a credit score. This three-digit number serves as a mathematical representation of trust, judging your reliability as a borrower rather than your actual wealth. The algorithm focuses on specific indicators, primarily your payment history, whether you pay on time, and your credit utilization, which compares how much credit you are currently using against your total available limit. The banking system exists to leverage deposits for profit. Your ability to participate in that leverage is strictly gatekept by how well you maintain this algorithmic track record. If you borrow $1,000 and pay back $1,280, you've paid for the privilege of holding someone else's cash. Interest is essentially rent charged for the use of money over time. Simple interest acts as a flat fee. Compound interest is more aggressive. It means every dollar you borrowed begins to earn its own interest, causing the total amount owed to grow exponentially.
Take a look at this graph of consumer debt. If you carry a balance on a high-interest credit card and miss a payment, the interest begins earning interest on itself. This accelerating downward curve is why a $12 burrito can turn into a $50 regret. When we flip the perspective to investing, that same exponential math allows a balance to double and redouble while you sleep. A small baseline investment begins to curve upward, eventually reaching a peak that far exceeds the original contribution. Interest is a mechanical multiplier. It functions as either a relentless drain on your accounts or as your most effective unpaid employee. The math remains the same. The outcome depends entirely on whether you are the one paying it or the one collecting it. This growth is necessary to combat inflation. When too much money chases too few goods, prices rise. Your currency becomes less valuable over time, meaning the same $20 bill buys fewer noodles and less gas than it did the year before. To fight these rising prices, central banks raise interest rates. This makes it more expensive for people and businesses to take out loans, effectively slowing down the flow of money. This intentional restriction of capital cools off spending. While this controls inflation, the sudden lack of spending often triggers a recession. A recession is a period where the economy decreases for at least 6 months. It is a painful reset phase of the cycle, where companies cut costs and jobs often vanish. Inflation and recessions are predictable systemic breathing cycles. Anyone holding their wealth in uninvested cash will see their purchasing power slowly eroded by these macro forces. Surviving these cycles requires a change in strategy. You must move from trading your raw hours for a paycheck to owning and providing value. Gold is a yellow metal.
no more inherently useful than the gravel in a driveway. However, its scarcity triggers a psychological response in humans that assigns it immense worth. Modern wealth creation follows a similar logic. Individuals who create systems or products with massive societal utility capture a large amount of wealth because people perceive those services as worth more than the cash in their pockets. This is why millions of people willingly trade away thousands of dollars in cash to hold a single piece of tech. They are trading depreciating currency for something they perceive as more valuable. You can harness this power through investing. By purchasing fractional ownership in companies that provide value, you ensure your money outpaces the steady erosion of inflation. There is one final rule to the system. Time is the supreme force. Wealth isn't built in days. It is built in decades as modest, consistent investments are allowed to multiply. The financial machine is designed to exploit those who don't understand the rules. But by aggressively eliminating debt, purchasing assets of value, and weaponizing time, you can rig the game back in your favor.